It's important to recognize that Social Security is not part of government expenditures. That is, those are transfer payments within the governments. They're not buying a good or service for the government. They're not included in government services. In other words, it's a government service that's being given to the citizens of the United States. Moving on then. Total expenditure for calculating GDP is going to be seen using this formula. That is C plus I plus G plus NX. Households receive wages, capital, interest, rent, and profit as income. Some part of the total income is not paid out to households by firms, but from an economic standpoint, this is undistributed profit as income paid to households and then loaned back to firms. So, looking at the total formula, what does it look like? For firms, corporations, those that pay out income, everything they receive as revenue from selling goods and services is total income, meaning Y. So in that case, Y is going to be C plus I plus G plus NX. And then for a firm, the value of its production is the cost of the production, which equals the income generated by the production. So the value of production equals income, which equals expenditure, or our GDP. So the GDP is the same thing as the firm's expenditure, which is a C plus I plus G plus NX. Signix is in perhaps one way to remember that. And then for households, it's the same idea, except they're just going to use the income on consumption expenditure, saving, and paying net taxes. For a household, then, it's going to be C plus N plus NT. That's for households. How do we measure the GDP, then? There's two methods. The first one is the expenditure approach. It measures GDP as the sum of the consumption expenditure, which is C, the investment, I, government expenditures on goods and services, which is G, and net exports, key point exports, not imports, of goods and services. So subtracting the exports minus the imports, the total value of the exports. GDP equals C plus I plus G plus this difference between the exports and the imports. In the second quarter of 2009, in trillions of dollars, the GDP, United States, was $14.2 trillion. What isn't included in the GDP? Well, used goods. That's not part of the current GDP because these goods were not manufactured during that period. The financial assets, such as stocks, because these are not expenditures on goods and services. So that's the expenditure approach. The second method is the income approach. The income approach involves more steps, several steps. It starts with the sum of wage income plus interest, rent, and profit income. This sum equals net domestic income at the factor cost. The main term to remember, though, is net domestic income at this stage. And then to change the measure from factor cost to market price, indirect taxes, less subsidies are added, because these are government taxes and transfers that affect market prices. The next step adds depreciation. That is the decrease in value in capital that results from its use and obsolescence. And then if everything is measured correctly, adding depreciation would yield a GDP and we'd be done. There's often, however, a statistical discrepancy. That is the difference between the expenditure approach and the income approach. The difference is measured as the expenditure approach minus the income approach, so that any statistical discrepancy is accounted for. And that's added to the sum to yield the income approach to the GDP. So there's a lot more steps with the income approach. Some other terms, GDP, and by the way, we'll go through a quick exercise to figure out the GDP at the conclusion of this. I know it's a lot to keep in mind, a lot of these terms. It'll be easier to understand once you actually try some exercises, try putting some numbers in the formula. But for now, I'll keep going with some of these terms. The gross national product, that is the GNP, the national product, it's the market value of all final goods and services produced anywhere in the world in a given time period by the factors of production supplied by the residents of the country, that is, of one particular country. So, pharmaceutical drugs produced in Ireland by a U.S. drug company is part of U.S. GNP, that is the gross national product, but it's not part of U.S. gross domestic product. How come? It wasn't manufactured in the United States. U.S. GNP equals U.S. GDP plus net factor income from abroad. I'll repeat that as the GNP equals the domestic product plus the income that comes from abroad. So that could contribute then to the gross national product. Disposable personal income is the income received by households minus personal income taxes paid. It equals GNP minus depreciation, minus any statistical discrepancy, minus retained profits by business, plus transfer payments, minus personal income taxes. Now, you don't need to say all of that fast, quickly, at any time, unless you want some sparkling dinner table conversation. Instead, this is written out here for you to see the term as it's defined. But to really understand that term, you'll have to plug in some numbers. And again, the exercises in the book do that, and then later on we'll try one brief exercise to give you an idea. But don't try to memorize all these formulas. Instead, just realize what the terms mean and understand where to start plugging in the numbers when you're asked to do so for the homework of the test. Last section of this, I'll go over real GDP versus nominal GDP. The market value of production, and hence GDP, can increase either because the production of goods and services are higher or because the prices of goods and services are higher. That is, the prices go up and the production goes up typically each year. So you have to calculate the real GDP at some point, and allows the quantities of production to be compared across time. Real gross domestic product, that is GDP, is the value of final goods and services produced in a given year expressed in terms of the prices in a base year. That is, expressed in the prices usually of the prior year. Nominal GDP is the value of the final goods and services produced in a given year expressed in terms of the prices in that same year. So one is comparing that as the prices from a prior year versus the prices in a current year. That is, it's trying to give people an idea of, well, how much is this worth now of what's being produced? We know that there's inflation and prices go up. Can you give us some idea to compare the two? How do we measure the two side by side? You know, there's some charts here to show how that's done. If you look at this first table, it has the GDP data for 2010. If there's only two items that are produced, books and coffee, there's a quantity here of 40 and a price of 25. If you multiply the two, that is the quantity times the price, come out to a market value of 1,000. For coffee, quantity of 1,000, price of $2, 2,000. The total brings $3,000. Add these two together, that's the nominal GDP that is in that year of 2010. Here's what was manufactured and the prices. Then there's different quantities and prices for 2011. Same two items, books and coffee, for different quantities. A quantity of 50, a price of 30, a market value now of 1,500. Coffee has the quantity of 1,500, a price of $3, $4,500, a total nominal GDP of $6,000. So how do you really figure out the difference, though? And the way to do that, then, is to use the quantities. That is, nominal GDP has doubled, but what is the real GDP between these 2 years? To determine how real GDP changes, suppose that 2010 is the base year. We're using the prior year as the base year. Then the real GDP equals nominal GDP in 2010. Now we need to determine real GDP in 2011. To do that, it's shown in the table below. Real GDP in 2011 is calculated using the 2011 quantities and the 2010, that is the base year, prices. So you're using the current quantities or using the past year's prices. So in this case, it's a quantity in 2011 of 50. Well, the price of books back in 2010 was $25. So now the market value drops to $12.50. Coffee at $1,500, using the prices at 2010 was $2, total of $3,000. Add these two together, come up with $4,250, which is different from the $6,000 figure given before. The purpose of this, again, is to show, if you're comparing 2 years, how the actual GDP can be determined. That is, without accounting for inflation, without accounting for the price changes, here's what it's worth in the prior year's dollars. Last step is I'll go over how to calculate GDP. This actually comes from your textbook. It's at the end of the checkpoint of 5.2. It asks you to measure the U.S. GDP. Using the chart below, calculate the gross domestic product, or GDP. Try to squeeze this all into one page here. Here's the various items, the dollar values. GDP equals the sum of the consumption expenditure, investment, government expenditure on goods and services, and net exports. So it equals these items. Again, to determine NX, you have to subtract the exports minus the imports, or X minus M. So if you start plugging in the numbers to that formula, come up with GDP equals $800 plus 400 plus 200 plus this difference here, which is actually minus $25. You get a total value of $1,375. And again, the amount of depreciation is not used. There's a bit more complicated example. There's a table here, and the question asks, assuming that the statistical discrepancy equals 0, calculate the following. Use the expenditure approach to calculate the GDP. That's one step. Use the income approach to calculate the net domestic product. Number 3, calculate GDP minus net domestic product at factor cost. Calculate the indirect taxes less subsidies. So here's those different items. Give you some time to look at that in the chart. Various items, their amounts. I hope that appears on your computer screen all right. And then go through now the formula on how that's determined. What numbers are plugged in where. If you use the expenditure approach, GDP equals that familiar formula now, C plus I plus G plus NX. So it's 4.97 trillion plus 1.14 trillion plus 1.37 trillion minus 0.08 trillion. Come up with a final number of $7.4 trillion. Using the income approach, finding the net domestic product at factor cost, well, that's going to equal wages plus interest, rent, and profit. Okay, so wages are here, interest, rent, and profit here. Add those two together, you come up with $5.88 trillion. 2C is GDP minus net domestic product at factor cost. Well, you take the earlier number of 7.4 trillion right here, and I know it's hard to get all this on one screen, minus number that you just calculated, 5.88 trillion, come up with 1.52 trillion. And the difference between GDP and net domestic product at factor cost equals 1.52 trillion, which is equal to depreciation plus indirect taxes minus subsidies. And then from the table, you already know that depreciation is 0.89 trillion. Okay, so if you plug that in, indirect taxes minus subsidies is 1.52 trillion minus 0.89 trillion, or 0.63 trillion. Hope that helps. I know it's a lot of numbers, a lot of information. And again, please send me an email if any part of this is confusing. Thank you.